Welcome back, everybody. I hope you're all feeling refreshed and ready to get back into it. We now have a really interesting mix of off and on-island views. GIA, the Guernsey International Insurance Association, achieved a world first last year, launching an ESG framework for its members. Joining us to discuss how insurance and investment funds can make the transition accountable, we have Robus Group Director and Group Head of ILS, Adele Gale. Adele was instrumental in the development of the ESG framework and supports the entire insurance industry in Guernsey when adopting the framework. We also invite the Managing Director of Aon Insurance Managers in Guernsey, Paul Sykes. Paul is also Head of Underwriting Solutions in the EMA region and was active in developing the ILS and commercial reinsurance sectors in Guernsey. Joining them, we have Gus Majid, CEO and founder of Paratus Group. Paratus is the world's first parametric energy price insurance company based in Guernsey. It is capable of writing cover against marine fuel, freight, jet fuel, gas, carbon emissions, power, and crude oil. Also joining is John Wilson, founding partner of Energy Growth Momentum. He is a growth capital investor investing into digital solutions for low-carbon, low-cost energy sector with a decentralized asset base, integrated, interconnected, and decarbonised via digital solutions. Finally, we have Emily Farramond, partner and head of ESG and sustainability in financial services at Baringa Partners. Emily and Baringa have recently worked with us at Guernsey Finance, producing the report you'll see on your tables. This report identifies the role of the finance industry of achieving a just transition to a net zero future. You can download the report using the QR code on our event banners. To get the conversation started, I'm going to hand you over to our moderator, John Rowson, GIA ESG Committee Chair, John Rowson. Over to you.
Yeah, I'm good. So thanks for that wonderful introduction, Steph, and thank you to my wonderful panel for joining us today. It's always a bit intimidating being in front of a room of our peers, and so please be kind to us as we do our best today. But if I could lead out with a bit of context. In light of what we've heard before the coffee break, and given the context of the current geopolitical situation, how does the energy crisis and climate crisis interlink, and how can proportional action be taken during the energy transition? And if I could turn that over to Gus in the first instance.
Thanks, John. Hello, everyone. So for my sins, I was an oil trader for 23 years. So I've had the fortune and misfortune to see these cycles in the 90s, where you saw a lot of producers being forced to lock in their forward energy prices at very steep discounts and going to the financial sector to gain financing. And again in the 2010s, when you had an abundance of shale capital going into the space, and suddenly IRRs went from 15% to 2% and then negative. So from my perspective, I think the energy markets are working perfectly. Unfortunately, it's highly punitive, and I think the consumers and the households are suffering. When you have, for example, UK electricity at historically, 50 pounds a megawatt hour, hitting 500. You've got NBP gas historically from between 40 to 60 pence a therm, suddenly now £7 a therm. It tells you that something is wrong in terms of the allocation of capital, where the profits are going and how to manage that. And I think if you take a step back, we're talking about 100 million barrels of oil a day in refined products that has to be extracted, developed, refined, and distributed around the world. So ostensibly, we're not reinventing the wheel. It's just how to get to that transition and how to do that affordably and as quickly as possible within the right framework. And I think ultimately it rests on these externalities that some of the previous panelists were discussing, the positive and the negatives and the pricing of these externalities. I think initially there was a rush in the adolescent phase, to my mind, of the ESG framework, where it was about labeling, it was about trying to find capital to go into the right bucket, and whether it was directed correctly in the most efficient manner. But ultimately, what we saw in the oil and gas space was a huge us and them shift and huge divestment away from oil and gas. So many of the leading experts at the IEA and OPEC, the leading energy trading companies, were saying it's all well and good, but this knee-jerk reaction will ultimately lead into prohibitive prices and underinvestment of 3 to 4, potentially 5 million barrels a day going forward. And then suddenly, even before March 2020, what we actually saw was a huge uptick in the price of gas, natural gas and LNG. Carbon emissions, carbon credit prices were hitting record levels, refining margins hitting record levels. And ultimately, this already started to cause massive undersupply in the market. And I think what's happened now is but the corollary to that on the positive externalities, you had record amounts of capital flooding into the renewable space, particularly the power generators. So really the question is, how do you balance that? And I think the tipping point has actually come about through the Russian crisis. And what that's done is allowed these discussions and the frameworks and the standards to start taking a step back and saying, look, we need a balance here. And what is the balance? What is the framework that needs to be put in place? And it's not really who's in the tent and who's out the tent. Everyone has to be in the tent. And I think one of the previous speakers was discussing the roles of the majors, Shell or BP. These are entities that understand how to produce 100 million barrels of energy and how to finance it and develop it. So I think really now we're at a kind of really critical point of what does the post-adolescent ESG framework do, how to frame it and how to design it in such a way that where are the responsibilities, where do governments step in, where do the regulators step in, who owns it, and how are shareholders who were initially forced out are coming back in, because everybody understands we do need hydrocarbons. And also executive committees and boards of directors. And I think once we have that in place, so for example, these discussions of windfall taxes, Pigouvian taxes, supernormal profits for some of these energy companies, what is the framework? How will it be mandated? And I think right now we are at a better place than we were pre-Russia, and I think everybody understands how important it is to have both sectors involved in the transition. So I'm pretty optimistic.
Thanks. It's good that that's an optimistic message, Gus. But if I could take the other point you mentioned there about the record levels of capital being injected into the renewable space, and perhaps direct that to John and ask how he's seeing that as part of the transition.
Yeah, and just to build on what Gus was saying, I mean, from our perception, there has been a structural underinvestment in energy, and that's been going on since 2016 because it's easy to take energy for granted. And the consequence of that is that the sector is inherently inelastic demand and inelastic supply. So you get that wrong and you end up with acute price volatility in the wholesale market. And that's where we're at now, compounded by kind of Russia's invasion of Ukraine and kind of import restrictions on commodities from Russia. But if I kind of just kind of briefly talk about kind of, the dichotomy that's perceived of, you can't have low cost and low carbon. This period is exceptional because I feel there's just been structural underinvestment, but there's a chance to kind of resolve that. But if I look at the kind of low cost, low carbon aspect of it, the kind of climate crisis is real and it can be quantified. And you look at the kind of losses associated with it over the past kind of 2 decades, and they're material. And the challenge is, as Gus was alluding to, it's a negative externality. So the people that consume and produce the CO2 emissions are not paying the cost for them. That's borne by someone else in society. And at some point that has to be resolved. And society as a whole, we kind of dealt with that with leaded petrol, when we discovered the consequence of kind of the lead in society getting into water courses and food. We dealt with that with CFCs, so negative externalities will be resolved because you can't go on punishing one group who are not getting the benefit of consumption. But just in terms of what it means in terms of consequence, the Munich reinsurance kind of company estimated over the past 2 decades, there's 11,000 climate events, and the consequence of that is 475,000 died because of those events, and the total aggregate losses suffered by those events was 2.6 trillion. So it's a big number already, and then you look at the kind of extrapolation of that with the kind of Swiss reinsurance company, and they're saying you extrapolate that from what could be kind of a GDP global loss of kind of 0.6% to, if you don't address this now and get to kind of one standard deviation of confidence that you're not going above 2% over pre-industrial temperature levels, it could be above 11% of GDP that suffered. So it's a big number with a big risk factor that needs to be addressed. The other side to the energy industry is that, unfortunately, you know, it's distributionally punitive to people who can least afford it. You know, so there's, if you look at the kind of the lowest income parts of kind of society, 4 billion people in the world survive on less than $2,000 a year. They consume 15% of the world's energy, but that accounts for over 20% of their expenditure. So most of their money goes on energy directly or indirectly. But then the top 1 billion people consume 36%, and it's only 4% of their income. So, you know, just building a little bit on what Gus was saying, you don't invest in energy, you have a real problem. And that's kind of, you have no low-cost energy, and that is felt by the people who can least bear that. So with the trajectory you've got, unless investment changes drastically, you could end up kind of with the world short of 8 trillion kilowatt hours of energy. And if you look at the consequence of that for low-income people, it's terrifying. You know, that's a 40% reduction in their income capacity. But also energy at that level is directly correlated to GDP. You know, you can pretty much safely say that every $1,000 of incremental GDP per capita requires 1 megawatt hour of energy consumption. So you don't have access to energy, you don't have a chance to improve your life, and you actually see a kind of regression. So there's a real need to deliver low-cost, low-carbon energy to address the climate-associated risk with the externality, but also to kind of empower people to live a better life as well. Our perception is that the two are mutually inclusive, and that kind of renewable energy, the marginal cost curve is coming down so drastically. You know, for solar and wind in the past 10 years, it's been 90 and 70% reduction in unit cost. So the decline curve is there, and scale facilitates lower costs within that sector. In the hydrocarbon business, you kind of see the opposite, actually. Hydrocarbons are fundamentally finite, and they're harder to extract. You know, that's why you're doing shale oil. You know, you're getting down to micro-Darcy extraction of oil, whereas, you know, it used to be very porous, and now you're having to kind of inject 60 million litres of water to frack open rock under extremely high pressure using 5 million pounds of sand. That's not easy oil, and it's an exponential decline curve as well. So as soon as you start producing, you have exponential decay in that oil production. So incredibly expensive, use a lot of consumables. For one well pad, you're at least talking 2,000 articulated lorries to take the consumables back and forth to one well pad. So oil is getting more expensive to extract, and as is gas as well. And that's why you've kind of had to go further offshore to find that oil and look at revitalizing kind of brown fields with water injection. And the water consumption is enormous. You know, so the kind of oil and gas industry is, Gus was saying, is 100 million barrels per day of oil production, but that requires 300 million barrels of water per day to inject to get that oil out. So it's not getting any easier. So, you know, our view is that you require kind of significant increase in investment, but kind of put your money where the low marginal cost is. You know, put your money where you're going to see transformational reductions in lower costs that facilitates a lower cost energy and a better society. And, you know, to Gus's point, energy has become pertinent, you know, and a crisis has made everyone aware and kind of brought it up to panel sessions like this. So policy is actively working on it. Capital is being mobilized. So a good thing has come out of a bad situation that has really made it relevant.
Thanks, John. Yeah, and obviously we've mentioned there that governments are going to play a role in sorting these problems out in the future. But Emily, if we could just focus for a moment on what the private sector and the role they have to play in the move away from brown industries to green industries.
Thanks. And absolutely, just in case it wasn't clear, critical role to play for each and every one of you in this room, and more broadly, across all areas. So we talked a little bit earlier, I think there was a stat of 275 trillion, I think someone said, in a report around the level of investment required. I think we estimate it's somewhere between 125 and $350 trillion required between now and 2050 to support us in transitioning. Now, that's a huge number. It's also a huge range. So I don't know if you're like me, I'm questioning, well, hang on, how can that be so wide and varied? And part of that's about the pathways that underpin the analysis around that number. So how do we influence that number? Well, the sooner we start to tackle the problem, the sooner we start to invest, then actually the quicker the transition is going to occur. It's going to be smoother, much more orderly, and less disorderly and less disruptive to core members of society. So I think there's a piece about taking action now. I think that's really, really important. There's also the piece about considered action, and I think that sits in two key areas. So is it a green asset that you're financing and funding? Is it a transition asset that you're financing and funding? And is it genuinely transitioning? So I was having a really interesting conversation with one of the fellows from Cambridge Institute for Sustainability Leadership last week. And what we were talking about was, she was really frustrated actually, around green steel. So the conversation we were having was, Emily, I don't understand why green steel's being funded. There are genuine alternatives that we should be putting capital into today, and we shouldn't see that being financed. So I think one key role is around asking questions. Is it genuinely a transitioning, an asset that requires transition, or are there viable alternatives available in the market that we should be putting funds into? I think that the third, and in no way the least important point, is we need to support a just transition. And so Adam talked about it earlier. If we think about a broad definition of a just transition, it's about leaving no one behind. So how do we do that? When we're thinking about how we need to go through this energy transition, we've seen this recently, haven't we? Those that are most impacted are those that can least afford it. So how do we support them in managing their lives, in being able to afford clean, renewable energy, and doing that in an appropriate way? And it's not just about, as Adam said again, it's not just about jobs in areas where we need to close coal mines. It's about the whole of society and how we can help them.
Great. Thanks, Emily. And thanks to the panel for giving us some great context there. But I'm going to drill down a little bit more into what we can do in Guernsey in our own small way. And I don't want anyone to be intimidated by these huge, massive issues out there. How are coverage and capacity restrictions limiting the ability of companies to transition effectively? And how can Guernsey help fill this protection gap?
Thanks, John. Well, to my relief, the Federation of European Risk Management Associations yesterday published a report on the protection gaps that are existing within their members around the energy transition specifically. And their report highlighted 3 areas where the lack of insurance was damaging their members' ability to transition. Firstly, there was limited cover due to a range of activities undertaken. So where the corporate was undertaking a range of activities, both some brown and perhaps some greener activities, insurers were declining to offer capacity. There's a lack of coverage around specific technologies, so offshore solar, offshore wind, hydrogen, fuel and storage, and then exclusions for property damage and bodily injury where there was any kind of link to a brown industry. So this poses a real problem for the risk managers affected because they can't support the transition of their companies if they can't adequately purchase insurance for the risks they face. And I think there's sort of 2 elements to that. There's sort of supply side issues with the protection gaps, and there's demand side issues. So from a supply side, I think that the insurance industry is generally fairly fixed in the underwriting guidelines that it sets for itself, and the way that it assesses risk tends to be fairly backward-looking and historic. So where the insured risk is historically been in browner industries. So, for instance, property risks associated with mining, and they're perhaps looking to invest more heavily into wind farms, it's difficult for underwriters to grasp that future and forward-looking risk, and to take the historic bank of data from that corporate and then project forward how that particular company's risk profile changes and how therefore they should price premium. So there's a real need for the insurance industry to gain confidence in more future forward-looking models and data that is available for them to embrace those risks. But there's also demand-side issues. So where insurers are prepared to offer coverage, is it at the right premium? Is there significant margins for uncertainty being loaded onto premiums, which is making the purchase of insurance, although possible, uneconomic? And that will also hold up those corporates' ability to transition and to meet their net zero targets by 2050. I think companies potentially are lumped together by insurers and by underwriters, looking at those trying to transition and those perhaps not trying to transition, and the difficulties that underwriters face in sifting through those and identifying actually who are the good corporate players and who are the less good corporate players, and then applying the correct premium pricing to those so that they can reward good behaviour and meet their own ESG criteria and their own kind of goals towards facilitating a transition to net zero by 2050. So I think Guernsey can really help with addressing some of these protection gaps. We've got a really, we're lucky enough to have a very flexible and proportionate regulator and also set of regulations. So within our regulations, insurance regulations in particular, we have the flexibility to allow innovative startups to come and receive the kind of various attention and detailed analysis by our regulator to allow them to kind of flex the regulations around the product that's being offered. And this allows startups such as Paratus, such as perhaps Momentum 2, to really come to a domicile which can embrace their innovative products and assist them in getting those off the ground. We also have a well-established captive industry here, with 40% of the FTSE 100 companies having a captive, and that being in Guernsey. And then captives, I think, have a unique role to play in covering protection gaps and warehousing emerging risks for corporates that aren't able to place that into the commercial market immediately. But they can, with an established loss record of 2 or 3 years, start to take those emerging risks around the transition that they're going through to market and placing those with commercial insurers.
Thanks, Adele. That's great. Turn to Paul, if I can, and keeping the focus on Guernsey for a while. How are the different insurance sectors you work in, such as captives and ILS, impacted by the ESG transition?
I think as Aon, we take a very holistic view of risk, and ESG is everywhere. It's really a social license to operate these days, and so there's no getting away from it. So we tend to view it as all risks, and we try to help our clients understand the interconnectedness of risk. Now, of course, climate risk has been with us for some time, but then we've been through, most of us have come across that term VUCA in our business studies over the years, volatile, uncertain, complex, ambiguous. I'm not sure that I've encountered in my lifetime career, and it's been quite a long one, such volatility as we're experiencing at the moment. And if it starts with climate crisis, followed by a public health crisis and the pandemic, leading to a supply chain crisis, then we've had inflation and an interest rate environment, cost of living, and that's not to mention the jobs crisis. It all sounds very much like 1970s, doesn't it? And indeed, this morning on Radio 4, driving in, I shuddered at the spokesman from Moscow intimating that nuclear war was an option. So that takes us back to Cold War 70s type of rhetoric. What is different, I suppose, around now to where we were in the 70s environment, the jobs crisis then, of course, was there weren't enough of them. Now, there aren't enough people to do their jobs, which is a whole new state of affairs. But if you don't have a purpose or strategy for ESG, you're not going to attract the talent anyway to fill those jobs. So very much it's, I think, around educating and ideally creating a culture around ESG, and where we're supporting our clients, going through their risk registers, identifying their risks, and really helping them to align with their PLC philosophy, purpose, and statements. And it's quite an interesting lens through the insurance company. It's almost like the tail wagging the dog, actually. But we get the opportunity to educate and to inform and provide insights to the risk managers and the executives that are the directors on those captive insurance boards. And then, which they love because they can then take that back to the main board, actually. And then that alignment with PLC, where it's PLC shareholders. Or if it's clients that need to raise capital, there are quite high hurdle rates these days, and a lot of due diligence where you've got to be able to demonstrate ESG credentials in order to attract capital. So again, we can help inform and provide insights to clients to help them make more compelling propositions as part of their capital raise.
Great. Thanks, Paul. So we've heard from Adele and Paul there how Guernsey businesses can help the transition, but with Gus and John with us today, it'd be great to get your insights and how Guernsey businesses have helped your transition or your way of supporting the transition. Let's go to Gus first.
Yeah, for us, the key metrics were geography, given that we write cover against the energy price, whether it's renewable power or carbon or refined products. So having the ability to be, in terms of time zones, able to write into Asia, into Europe, and potentially into the States was very important. But I'd say the two key elements were the quality of the regulator. Did they have the financial understanding, the resourcing, and the engineering, so to speak, in terms of understanding what we're trying to do, what we're trying to get to, which they did, and we were very impressed and very happy with the regulator. And secondly, probably as importantly, with the quality of the service providers, the insurance managers, the auditors, the lawyers, and also when you're trying to innovate in terms of things that haven't been done before, in terms of the type of insurance and how to look at that, and working with the London barristers and all that sort of stuff. So we have been incredibly happy with the outcome and the resources and the setup in Guernsey.
Thanks, Gus. And John, have you got anything you'd like to add to that?
Yeah, I mean, I would just kind of echo all of that. I mean, plus it's not a hard place to come to. So good location, good people, good food. So you kind of got my attention already. But kind of as kind of Gus was talking about the finer points, that's our view as well. Kind of preeminent regulator, which is important to us from a kind of perception but execution. Excellent financial service support. We're kind of delighted with the assistance that we get in country. Maybe the additive point would be, which is relevant and pertinent to the transition, we do our impact consulting out of kind of Guernsey, so using Innovest, and we find them to be kind of best in class, and that's a considerable amount of work on our part. It was talked about in the prior panel, but ESG can be kind of formulaic. You've kind of got S&P and Moody's kind of coming out with ratings. How ESG am I out of 100? Impact is more nuanced and arguably requires a little bit more kind of grey matter applied to figuring out what the consequence of impact is, and the kind of scope 4, kind of scope 1 to 3 was talked about, but scope 4 is kind of what we're kind of looking at as well as a positive externality. If greenhouse gases are the negative externality, the positive is the abatement of them, and everything we look at has to abate greenhouse gases. And our view is that we offer that for free to clients, so it's embedded value that makes us sticky with them. And the expertise is here in Guernsey to kind of guide us through that process and help us kind of try and quantify it, but do it in the right way.
Great. Thanks, John. That's really useful. So Steph mentioned in the introduction that Baringa have recently worked with Guernsey Finance in researching and reporting on the opportunities for the finance industry in managing a just transition. But I'd like to ask Emily, if I may, what were some of the opportunities that you identified for the insurance and investment fund industry?
Thanks. So hopefully you'll all have a chance to read the report and take the QR code that Steph offered, and it was great working with Guernsey Finance on that report. There are a few opportunities we identified. And I want to get the numbers right, so if you wonder why I'm reading them, I don't want to misquote them and then you check me on it later. So around the net asset value of the Guernsey Green Funds, we predict there'll be an increase from £4.2 billion in 2021 to almost 60 billion in 2040. So massive opportunities for growth, specifically in that area. But how are you going to achieve that? Again, so annual sustainable investment needs to scale from 1.3 billion last year to 7.7 billion annualized run rate to support that. And where does that investment need to take place, or where do the opportunities lie? So we really focused on the 4 key sectors that are critical specifically here. So electricity and kind of the decarbonisation of heat, transportation and a move towards electrification again, buildings, and then infrastructure. And what I will point you to, there's a really helpful graphic in the paper, I think it's around about the middle, which then looks across each of those sectors. And it says, okay, where do we think then investment needs to flow for the specific, more detailed areas of kind of the newer technologies across each of those areas. So I'd point you to that. I think it's hopefully helpful and will support you in guiding you to think about where you might want to invest. But there's a huge amount of opportunity there. I think it's called the Tech Transition Maturity Assessment, if you're looking for it, by the way. I guess from an insurance point of view, Adele covered quite a lot of that in the summary that she gave. I guess taking a step back to the role insurance plays in society, and I think this is again important around the just transition, it's supporting communities at moments of kind of loss events. And so what is it there for the opportunity for the insurance industry here associated with that? Well, I think we're going to see, as you won't be surprised to hear, I suspect you're already seeing growth in premiums associated with physical and transition risk events. I think then we're actually expecting, if you think about the depth of expertise that sits in the insurance market, it's phenomenal around modelling risk, physical risk, and you know, that the catastrophe modelling, the risk expertise, and actually development of some of the advisory services associated with that. I think then in terms of building captives around supporting assets that are transitioning from brown to green are kind of 3 great areas of opportunity for the industry. And I don't know, Adele, if there's anything that you wanted to add in addition to that.
No, I mean, I think I agree with those. And we've seen examples already at Robus of PLCs that are looking to achieve their net zero targets and are finding themselves, you know, with these sort of protection gap hotspots. I mean, an example we were talking about before was a property management company with a captive in Guernsey that is looking to incorporate better sustainable construction techniques into its investment, and was finding that they were unable to secure insurance for the building that was constructed. Well, that becomes a stranded green asset, I think the words you used, which kind of the first time I've thought of it in that way. But if you can't insure a building that you've built, you can't sell it because nobody's going to buy something that could fall down tomorrow with no ability to insure that risk. So it's a great example of where captives can get involved and can warehouse those types of risks for 2-3 years, while the kind of the tech solutions. So I think there's tech solutions out there that are starting, like the mass timber consultants that are developing products to take photographs of construction along the way, and then they can give the data around, you know, the construction techniques that were used to insurers who maybe in the course of 2 or 3 years can analyse that and get comfortable with the risk of actually insuring a high-rise building which uses a lot of timber in its construction. So that's just one example where where a captive can really help, and you know, all of the opportunities I think you laid out in the report, the incredibly interesting report, are open to Guernsey, and it's kind of beholden on all of us in Guernsey really to sell those to our existing clients and to make it clear that we're here and able to help where we can.
Great. Thanks, Emily and Adele. Now, if I may, I'm just going to move on to the products, the frameworks that can support a just transition. So do you think the development of financial products and frameworks has helped or hindered the transition so far? And as a follow-up question, does product development hold the key for the energy transition? If I could direct that to Paul in the first instance.
Yeah, look, and I think products and frameworks are probably easier, and makes it an easier question to answer. If we think about what product is, behind product there's usually investment, capital and investment. So there needs to be some return on that investment. And there are products designed that are specifically for ESG, and there are examples of that. I'll come on to them. But very often it's about providing, as we say, embedding a culture and providing some insights into products that make them more attractive and customer friendly. So it's our job is to help clients to, I suppose, make that more transparent. I think transparency and disclosure is a strong part of the product to market process. But I did say there were products that have been designed with ESG in mind. The most relevant recently of that for Guernsey was the volcano bond, whereby there was risk transfer to the capital markets placed by on behalf of the Danish Red Cross. So that was quite innovative in the sense that they only had funds of $150,000, and they wanted to be able to provide relief to communities in the event that any one of a number of 10 volcanoes erupted around the world. So they managed to achieve some contingent protection to the sum of $3 million for the 150 that they had. So that was a product, if you like, that sits very nicely in the ESG space. Where we were able to help them with that was, first of all, the Danish Red Cross wanted to do a lot of due diligence on Guernsey. The fact that it had the green strategy, the green investment fund, and good credentials helped the choice of domicile for that product. But the kite mark, so the client that delivered that solution, brought it to market, was called Replexus, using an incorporated cell, Dunant-Re, and it took on the GEA kite mark as a way also of supporting those green credentials. And that helps through the 4 pillars, which is governance, the underwriting risk, investment, and the disclosures. That helped to, I suppose, demonstrate and measure the ESG properties of the product and service delivery. So in that sense, it's well said that what gets measured gets done, and I think frameworks are important, and the ESG framework has been quite game-changing in order for us to be able to demonstrate green ESG credentials and thereby help to deliver new products to market.
Thanks, Paul. Adele, as one of the architects of the frameworks, anything you'd like to add to that?
No, I think I echo probably Paul's comments on that. I think the products, as I see sort of like the Guernsey Green Fund or the kind of kite mark being a key framework, they start conversations. They allow us as insurance managers to have conversations with the parent companies of the entities we look after, to have conversations with the portfolio allocators at the funds which own cells in Guernsey, to have conversations with the pension funds that set up captives here. But it isn't really the end of the story. It's really just the door opener for me anyway, and that's incredibly helpful in starting those conversations. But it is probably beyond Guernsey, and I think there are better experts here to talk about the frameworks we need to ensure a just transition and an accountable transition, so that we are all held to account for the actions taken. But in terms of Guernsey, our products and frameworks, I feel have been incredibly helpful, but they are limited in their ability to sort of go all the way. It's actually about strong governance, about transparent disclosures at a parent level, and about clear and accountable actions towards the end goal.
Thanks. And I'd just like to go around the rest of the panel, starting with Gus, and get your thoughts on frameworks for transitioning.
Yeah, I think we're definitely moving away from the singular labeling phase into a more balanced framework. I think a lot of the most potentially efficient actors within the space have begun to understand the frameworks and standards. They've all tooled up with the best ESG experts in-house or consultants. And I think we're moving now from labeling into actually doing, and in a sustainable way. And you see that across the space. There are a lot of similarities if you look at the previous transition, the fossil fuel transition, where essentially where we come in on the renewable power side with the ILS risk transfer business. You saw in the 1990s, as I was saying, the crude producers being forced to lock in their 10 or 15-year forward oil price at a 40% discount, and at the same time having to pay LIBOR plus 15 for financing. And then again, we were talking about positive externalities. At the same time, renewable power producers coming in with a flood of capital and essentially tripping over themselves and bidding for acreage with, in this case, seabed rights, hunting for the same talent in the white-collar space, and IRRs going from the 15% to single digits. So I think what's happening now is it's all balancing out, and actually where we're moving to is purely focusing on the business model, on the financial model. Do these businesses, do these opportunities, do these assets make decent returns, and solving for that. And where we come in is actually we see a bottleneck. You see a lot of asset managers kind of essentially you say moving upstream. They're moving into, instead of just funding these assets, they're actually developing them. They're hiring internally. They're moving into the seabed rights, and they're purchasing seabed rights. But actually, the point where we come in is and it kind of still we find it really quite interesting, is there is a huge bottleneck in terms of how you transfer risk. Why are these entities forced to enter PPAs? Why do you have to give these only a limited number of players in the energy space? Why do you have to give them 40% discount onto the forward power price? Why can't you get a better return? So we come in and say, well, that's what we will do, and that's how we facilitate it and bring our expertise into it. But I think it's part of a phased growth, and definitely we feel it's definitely moving, particularly post-Ukraine, in the right direction.
Great, thanks, Gus. Just on frameworks, is there anything you'd like to add, Emily?
I think we hear a lot of complaints about frameworks across ESG, and a lot of discussion about the complexity. Many of you will have heard the word spaghetti soup. I'm sure if you haven't, you will start to, and that will increase. And I think that's really, really unfortunate, because I think we need to remember what the frameworks are essentially designed to do. So they're there to support consumers and investors in genuinely being able to understand what companies are doing around ESG and how they're supporting both the transition and the just element of the transition. And that's absolutely critical, I think. So the frameworks for me, whilst there are a number, they're quite specific. It's easy to find the ones that are relevant. I think then just adopting and adapting those becomes critical. But what do? They're not only supporting investors and consumers in understanding essentially the kind of just transition, the ESG, the credible transition plan element of what companies are doing and what sits within their strategies. But they're also, I've lost my train of thought, I apologise. I think essentially what they're trying to do is provide that level of clarity and comparability. And it's really hard trying to compare, right? Because every company is different. What it's trying to do, the emissions that it has, is really, really wide and varied. But essentially those frameworks are trying to help all of us to do our jobs better, to be able to, to drive action, to have conversations which say, how are your emissions higher than this organisation that looks exactly like you, or at least very similar? I'd like you to explain that to me, and I really want to understand that. And that's why they're really, really important. They're really valuable, and they've got a role to play. and will continue to have a role to play. I guess the other comment I wanted to make is, and I think again, Adam talked about this earlier, and Julia as well, is that we're trying to build a common language around something that has never had a common language, and we're trying to do it globally across all sectors and all activities that we do in the world. And so that's a little bit difficult, and it's taking us a bit of time, and we've all got very different views about what it should look like. But equally, I think that's okay, because I think having diversity of thought and opinion and insight is what we need to help us all make much better, much more informed decisions.
Brilliant. Thanks very much for that. Finding yourself again. And now just going to John, maybe you could talk about how frameworks are managing to drive real-world change.
Yeah, so I guess where the kind of rubber hits the road is we're big proponents of the framework because we're raising kind of Fund 3 now. But the fundraise process initially was quite difficult because we were articulating a narrative no one wanted to hear, and that's a difficult sell. So what the kind of frameworks have done is almost kind of, as has been alluded to now, is kind of just create a comparability to actually kind of, demonstrate the kind of the value embedded in what we were investing in. And we can really need kind of transparency and accountability around that application to actually facilitate us to kind of raise capital. It's still a long lead time though, because as mentioned earlier about the kind of capital allocation to kind of ESG, it's considerable now, something like 35 kind of trillion. And it also mentioned earlier on was the SFDRs, which is the kind of the European kind of taxonomy. And if you look at the impact allocation from that, so 50% of it is ESG focused, but only 5% is impact. And we're targeting that impact to kind of say, like, we can offset and abate CO2. We really care about what companies produce and the consequence of that for society. But you're kind of, that asset class is growing, but the lead time associated with it is those fund-to-fund guys are out raising their own capital. So they're articulating their proposition to insurers, endowments. So we've got to wait for them to raise that pocket of capital. And then we've got to speak to them and understand how they're actually applying that taxonomy in terms of trying to quantify it so we can demonstrate the attribution. So the lead time is long, and that's been the frustrating thing for us. But the fact that it's there means that it's going to facilitate it kind of going forward. And where the kind of rubber hits the road is that, when we get allocated that capital, we can apply it in a way where we can see kind of real change. And as I mentioned earlier on, so the businesses that we invest in, kind of digital solutions for the energy sector, principally the power business, and most of that is in solar. The beauty of kind of solar is it's homogeneous, it's accessible. There's a lot of knowns around it in terms of you don't get much degradation. It lasts for 25 years plus, so you get certainty, albeit with weather transients. Is the sun there? Is it blocked by a cloud? You get kind of certainty of the output that you're getting from that asset class. Then you've got to figure out how you monetize it, which kind of Gus was talking about. But the beauty of that is that you can digitize a lot of that because there's knowns. And maybe to kind of talk about kind of Gus's example there, so stuff that we would look at is digital software that fractionalizes the power output to compete against PPAs. So if there's a large solar generator, why does he have to go to an intermediated market to speak to some retailers who kind of give him a heavily discounted price? Why can he not go direct to large C&I consumers who need that power? And we're looking at software platforms that actually fractionalize that power output and actually provide transparency in a digital contract. So the consumer knows what they're buying, they know what their net load is and what the offset is from the solar, and the solar guy's cutting out the middleman that's kind of, giving them discounted returns on their asset. And so that's where the kind of rubber hits the road for us, is that kind of when we get the capital, there's a lot of innovation in this space because it's exciting and it's interesting for people. And there's a lot of smart and talented people that are falling out large organizations who have great ideas. They just need to be mobilized by the capital to pursue it. And there's a big crisis at play. So there's the opportunity for them to sell. And we've seen significant growth in our assets. So if you look at Fund 2, we started investing in 2019. And the aggregate kind of revenue of the portfolio was like 33 million. This year, it'll be about 140. Next year, it'll be about 200 million. So, and we're not even selling the carbon benefit. We're just selling off the requirement for digital solutions in the power sector. and where we think we can monetize it later on is actually looking at carbon credits around that as well. So yeah, that's where we kind of see the rubber hitting the road and the benefit of those frameworks driving real change and financing innovation.
Great. Thank you very much. Well, unfortunately, we're out of time, so I hope you, as I do, think the panel have done a fabulous job, and I hope you'll join me in thanking them in the usual way. Thank you.
Thank you very much to all our panellists there. Especially thank you, Gus, John and Emily, for your unscripted but kind words about Guernsey. There are so many fantastic companies, insurers and investment managers already taking practical action to manage the energy transition. Rupert will shortly pick things up again to end the day, but first I'd like to take the chance to thank all of you as well for coming. We are very grateful to all of our sponsors for their support of Sustainable Finance Week. Today's headline sponsor is HSBC. To bring our sessions to a close for today, I'm pleased to welcome HSBC Head of Commercial Banking for the Channel Islands and Isle of Man, Eileen Ayotte, who will give today's headline sponsor address. Thank you, Eileen.
Thank you, and thank you to all of you, today's guests and speakers, for all the work that you are doing to drive the energy transition conversation forward. For my part, I believe that financial institutions have a very important role to play in helping the world transition to net zero. Making our own business carbon neutral is, of course, extremely important to us, but I think our real value comes in helping our customers, companies, with their sustainability ambitions. At HSBC, we are working to prioritize financing and investments to help clients in a wide and diverse number of sectors to lower their carbon output. And it was mentioned earlier, we're looking to provide between $750 billion and $1 trillion in financing by 2030. And I take on board Harry's feedback. Hopefully, together with the wider industry, we'll well exceed these numbers in the coming years. And this, I'll point out as well, isn't just for large multinational companies, it's for small and medium-sized enterprises as well. And we have a number of initiatives such as green financing to help. Providing funding is a significant part of what we aim to do, but I think we can also play a role in terms of educating and informing customers about their options. Events like this week are important, as I said, in terms of moving the conversation forward, and that's why we're proud to be a sponsor today. Thank you again, and I look forward to hearing more of your insights in the coming days.
That's great. Many thanks, Aileen. There you have it, another thought-provoking day and Sustainable Finance Week, and I hope we'll all take plenty away from it. I found it encouraging that so many sectors of the insurance industry, such as captives and ILS, really have something to offer in the just transition towards net zero. I also urge you to download a copy of our Beringa report, and as you see, some are on the tables in front of you. The more we cover the topic of sustainability, the more we discover just how relevant the finance industry is in fighting climate change. It never ceases to amaze me how we constantly learn of new avenues to pursue, and in Guernsey, we're up for the challenge. Before we close for the day and reconvene for drinks and networking, I'd like to thank our sponsors for their support of this event. Again, HSBC as headline sponsor, and particularly Channel Islands and Isle of Man Head of Commercial Banking, Eileen Ayotte. Her address today was great. Thank you very much indeed. The International Stock Exchange as our first ever carbon offset sponsor, as well as registration sponsor OSIA, coffee sponsor KPMG, and to locate Guernsey, our exhibition sponsor. Not forgetting the Duke of Richmond Hotel for hosting this week and our valued media partner, the Financial Times. If you want to know more, we have an extensive library of literature on Guernsey's role in sustainable finance. You'll also be able to read the full version of our new report, which we've discussed earlier today. Simply head to our website and click either the literature or resources tabs from which you will be able to filter to the correct topic. Or simply scan the QR codes on the banners that you see located around, and they will take you to where you need to go. It's very important for us to know what you thought of today's event so that we can make them even better in the future. Therefore, we ask if you'd kindly take a moment to complete our survey online, which will be sent to you in due course in a post-event email. We'd also appreciate if you could place your lanyards in the bowls when you came in at reception on the way out, and if you could let us know how you feel the afternoon went. I've also been asked to say that the art exhibition that was put on yesterday by Art for Guernsey, especially for Sustainable Finance Week, will be at the Royal Court for the rest of the week until Friday for those that you missed it. So please do visit the Royal Court if you can. Hopefully now you can join us for the drinks reception, which is going to be upstairs on the terrace. I'm sure you'll have plenty to discuss today. We've had a jam-packed afternoon. So thank you for coming again, and especially those of you who made a trip over to Guernsey. So we wish you all a very safe journey back home and wishing you a fantastic evening. Thank you very much indeed.